Hello there, this is forexbrokers.net, and this video talks about monetary and fiscal policy. These are fundamental concepts, so don't expect anything on this chart here, but a bit of a visualization of these concepts. Most of the details you can find on the article that comes with this video, and it is only important to understand the difference between the two and who sets the monetary policy and the fiscal policy, and these are the two concepts they explain here. And in order to move along, we should split the screen here and say that this is monetary, and this is on the left side we have monetary policy, and on the right side we have fiscal policy. Why does it matter for a currency pair, and why it is important for fiscal policy to follow monetary policy when it comes to coordinated action? Well, the current crisis, the coronavirus crisis that reached the Western world in 2020 is the perfect example. In normal economic conditions, when the economy functions, even if you have bigger inflation or low inflation and so on, monetary policy is enough. So monetary policy tools are conventional, and here you think of interest rates, you think of looking at inflation levels and so on, but inflation in line with central banks' expectations. Monetary policy is being set by central banks. And in normal times, central banks, what they do is they raise the interest rate, so they raise the interest rate level when inflation moves to the upside, in order to bring inflation to the target, to 2%. If inflation exceeds the 2% target, then the central banks will come and lower the interest rates. And these are conventional monetary policy tools, as all central banks in the developed world have a mandate to target inflation below or close to 2%. The 2% is viewed as a level that more or less corresponds with sustained economic growth, meaning that the inflation level is far away from the zero level, so that there will be no deflation, and the inflation is not that high, so the danger of hyperinflation appears. So these are conventional tools, but sometimes due to various factors like financial crisis, like it was 2008-2009, or oil prices collapsing, like it happened when the price of oil fell from the $100 level to the 30 level several years ago, or when you have a global economic recession like we have now with the pandemic and so on, then the central banks are forced to use unconventional measures. Now, unconventional measures, into this chapter we have quantitative easing, meaning central banks buy their own government bonds with the intention of influencing the yields, lowering the cost of borrowing, so companies and banks will have access to cheap capital in order to deploy the money into the economy, and then for the economy to gradually recover. It is just a measure that was an unconventional measure introduced for the first time by the Federal Reserve of the United States after the great financial crisis, adopted with quite an energy by the Bank of Japan, that even now outpaces everything that is known in terms of quantitative easing, and so on and so forth. In some other jurisdictions, for instance, the European Central Bank chose, besides quantitative easing, chose to offer long-term refinancing operations, or targeting long-term refinancing operations to commercial banks by offering incentives to take a loan in order to in order to stimulate the economy. And in 2020, these loans are being offered at a negative rate. It means that if you, as a bank, you take a loan from the ECB, you will take it at a negative rate, meaning that you will give back less money than basically is money for free from the central bank. Just that the banks will do so, and they will stimulate the economy. All in all, this is monetary policy. And depending on the gravity of the situation, depending on the problem that the monetary policy needs to address, then it may be a simple verbal intervention, like the ECB delivered one recently when the euro-US dollar reached the 1.20 level. Philip Lane, the ECB chief economist, came out and said that, well, the ECB is not monitoring exchange rates, but the euro-US dollar rate matters, and the euro-US dollar dropped from 1.20 to 1.18 and 17. That's still monetary policy and verbal intervention. It also made out of forward guidance. It is made out of everything that the central bank may do to influence the target and to fill their mandate. Speeches that you see at financial television, or you read in financial newspapers, and so on and so forth. Fiscal policy is everything that the government does. The central bank acts as a bank to the government. So fiscal policy deals with, let's say, in each country, with the VAT policy. So VAT is the VAT, for instance, is one measure that belongs to the fiscal policy. You saw that during the coronavirus crisis, most countries in the world, besides the central bank reacting to slashing the interest rates to zero, unconventional monetary policy, unconventional measures, everything, all the policies are eased around the world, the fiscal policy or the fiscal stimulus also hit the market. In Europe, you have fiscal stimulus in almost all countries. In Germany, for instance, there is the Kurzarbeit scheme, means short-term work, in the sense that workers are paid full-time, but they are working only a few hours. That's fiscal stimulus, and the difference is supported by the state. It's still creating money. In the United States, the Congress approved $600 a week for, I don't know how long it was the period, a paycheck, in order to support families during the lockdowns that we saw with the coronavirus crisis. This is fiscal stimulus. Together, monetary policy with fiscal policy make the most of the response of an economy. They are both important in the value of a currency. If one is expanding and the other one is expanding as well, so both monetary and fiscal expansion usually leads to an increase in the money supply, in time leads to inflation, but it depends very much on the level of the M2 money supply, for instance, that is created. And last but not least, in Japan, for instance, there is one more concept addressed by the Abenomics, the three arrows launched by the former Prime Minister Shinzo Abe. The Abenomics concept is based on monetary policy, easing, fiscal stimulus, but also structural reforms. This is something that the previous ECB president, Mario Draghi, insisted all the time, that in the euro area, if you have easy monetary policy, but you don't have structural reforms, then that's a problem for the overall future. Also, and I will end with this, the euro area lacks a common fiscal agenda, and that is a problem for the euro moving forward. Again, it is not just the VAT, it is everything that the government decides in terms of taxes and stimulus. More in the article that comes with this video. Bye bye.